Once an asset has been, so we will talk about depreciation of revalued assets. Good evening once again. Last week we ended at illustration 13, so today we will continue with depreciation of revalued assets. So we are saying once an asset has been revalued, the following treatment is required. So the other day we did revaluation, and I think this shouldn't be a new thing to us. All right. So we said once an asset has been revalued, the following treatment is required. One, depreciation must be charged based on valuation less residual value over the remaining useful life. Okay, so what we are trying to say is that once there is revaluation, okay, sorry for my network. So we are saying once revaluation has been done. So the other day we spoke about revaluation. Depreciation must be charged based on valuation. So Monday, I said that when they need to revalue their assets, from the date of revaluation, the depreciation is charged on that revalued amount. Okay, the depreciation is charged on that revalued amount, not on the historical cost, because mostly we use the straight line method. So the depreciation is mostly charged on the cost, the acquisition cost. But whenever there is revaluation, the depreciation is now charged on the revalued amount less the residual value as at that date, and also the useful life as at that date. Okay, so you solve some examples and you will get to appreciate the concept. And we are saying that in the year of revaluation, that depreciation charge must go to what? P&L, that's the income statement for that particular year. So you come to the timing of revaluation. We'll talk more about that one. So I'll leave the second point. Now, the third one is talking about annual reserves transfer. So the other day, I explained what revaluation reserve is and also the treatment of the revaluation differences. When you get revaluation gain, how do you treat it if it is for the first time? When you get revaluation loss, if it is first time, or maybe previously you had revaluation gain and going forward the loss you had is more than the gain you were having in the account or in the revaluation reserve. And you also made mention that revaluation reserves cannot be negative, right? So there can be annual reserves transfer. So there can be transfer from the revaluation reserves to what retained earnings. And that's what we termed as what extra depreciation in the revalued amount. So one will ask, how do we determine this extra depreciation? So we are saying that the depreciation charge based on the revalued amount. So after you've done the revaluation, you compute the annual depreciation charge on the revalued amount, and also you compute the annual depreciation charge on the historical cost, not accumulated depreciation, the annual ones. Okay, then you find the difference. So it will be the depreciation on valuation minus what? Depreciation on the historical cost. And the answer will give you the what? Extra depreciation on revaluation, this one. So you will transfer that one to a statement of changes in equity. So you know the components of financial statement, there are 5, and statement of changes in equity is one of them. Okay. So you saw one example where you appreciate this particular um, principle. Okay. And this is a accounting entries, that one, we know it already. So let's talk about the timing of revaluation. Okay, so this revaluation we've been talking about, they are saying that it may take place at the beginning, during, or end of financial period. So if we talk about, we take, let's say 2018, the revaluation can take place at the beginning, let's say 1st January. It can also take place during, let's say middle, let's say 30th June or 1st July. Also can take place at the end of the financial reporting, that is 31st December 2018. And we are saying depending on the timing of revaluation, whether it took place at the beginning, during, or end of the financial period, the treatment of this revaluation results, whether it's surplus or loss, and the current amount of the assets will be different. Okay, so depending on the timing, okay, that one to determine how you are going to treat the revaluation reserves and all that. So first of all, let's talk about where the revaluation takes place at the beginning of the year. So let's say if it is January, sorry, 2018, and the revaluation is on the 1st January 20, 1st of January 2020, 2018, sorry, we are using 2018 as an example, right? Now, if the revaluation took place on 1st January 2018, you can determine the carrying amount as at 31st December 2017. And that 31st December can be carried forward to what? 1st January 2018. Because the other day I told you that the revaluation or the closing balance of one period becomes the opening balance of what? Another period. Say the closing balance for 2017 like this will become the opening balance of what? 2018. So where the revaluation takes place at the
Hello,
beginning
good
of the year,
evening.
where the hello, yeah, evening. Hello.
Yeah, pa, we can start. Why?
Okay, so we've already started though. Okay.
Uh,
So where the
oh,
revaluation takes place at the beginning of the year, you are saying that it is assumed that the revaluation is on the first day of the reporting period. Okay. So the revalued amount, that's the new value, will be used throughout the year. So the depreciation for that particular year will be charged or will be calculated based on that revalued amount. So let's say in this case for 2018, for instance, the revaluation took place on 1st January 2018. It means that throughout 2018, the figure that we will be using or the figure that we use as depreciable amount will be the revalued amount, because right from 1st January to 31st January, you will be using what? The revalued amount. One will ask, how are you going to determine your revaluation surplus or revaluation loss? So you calculate your carrying amount as at 31st December the previous year, here 2017. Okay, then you compare that answer with your revalued amount as at 1st January 2018. That will give you the gain, revaluation gain or loss. Don't be confused because this one is 2017, because I said 31st December 2017 can be carried forward to 1st January 2018, because the closing balance of 2017 becomes the opening balance of what? 2018. Okay, so we will solve questions on that and you understand what I'm trying to explain. Now, let's talk about where the revaluation takes place during the year. Let's say in the middle of the year. In most of the examination question or the past question, you see that the revaluation will be on the middle, on the 30th June or something. Yes. So in that instance, how are you going to calculate that depreciation? Now, I forgot to say one thing about the first one. So the depreciation charge for the first one will be one. That's based on the revalued amount. If the revaluation takes place at the beginning of the year, the depreciation that you are going to charge will just be the one on the revalued amount. That is throughout. But where the revaluation takes place during the year, that let's say in the middle of the year, okay, that one we are going to have two depreciations. Okay, depreciation charges. One will be on the historical costs and one will be on the revalued amount. Okay, so we are saying that with this one, the depreciation will be in two parts, as I said. The first part will be on what? Hold on, please, I'm coming. So the first part will be on the proportionate basis of the old value. And here, if you're talking about old value, mostly the historical costs up to the date of revaluation. And the second portion will be on the proportionate basis on the new value of the assets. That's the revalued amount. Now we are seeing proportionate basis, proportionate basis. So one will ask, what is that one too? So that one is, let's say the asset was revalued on the 30th of June. So in 2018, from 1st January to 30th June will be 6 months. So if you are calculating depreciation, after using all the formula, you have to multiply by 6/12. That's the proportion one, the proportionate basis, because it's not for the whole year. And also the other parts, that is where the revaluation was done, that's 1st July or maybe 30th June in that year. From the 1st July to 31st of that period too, that one to be also 6 months. So they will be calculated on a proportionate basis. So whenever you calculate so the first one, the first part will be on the historical cost. Second part will be on what? The revalued amount. And also you check the number of months, okay? If the revaluation took place on maybe April, you know that the one on historical costs will just be 3 months, January to March ending. That's all. Okay. Then the revalued amount, the depreciation you calculate on revalued amount will be from April, 1st April to 31st December that year. Okay. So that's also one thing about that. Now let's talk about where revaluation occurs at the end of the year. So now we've talked about when the revaluation takes place during the when the revaluation takes place at the start of the year, during the year, and now at the end of the year. So this one too, let's say the same 2018, but the revaluation was done on what? 31st December. So here it is assumed that revaluation takes place on the last day of the reporting period. So the old value or the historical cost will be used throughout the year. So this and as this situation too, the depreciation will just be one. Okay, you just use the historical cost to calculate the depreciation. Therefore, the revaluation result, that is whether it's gain or loss, will be the difference between the carrying amount of that asset at the year end. Okay, carrying amount as at the 31st December 2018, and also the revalued amount. Now, let's say revaluation happened or occurred on 31st December 2018. You calculate your carrying amount as at that date. And this same date can be carried forward to what? 1st January 2019. Okay, so 1st January 2019. Okay, because the closing balance of 2018 becomes the opening balance of what? 2019. All right. So please, we will pick a question on where we have the extra depreciation, and I've already explained that one, how you are going to determine your extra depreciation and how you are going to treat it. So if you are getting extra depreciation, you transfer it from what? The revaluation reserves to what? Retained earnings. And that one will be done in what? Statement of changes in equity. Okay, so that one, I think this illustration 4 is an example of that. Okay. Please, any question before we move on?
Um, okay, Pa. Hello.
Hello. Yeah.
Yes. I have a question. So with the last point,
Okay.
if the evaluation was done on 31st December, you're saying we'll use the historical cost, like the carrying
Yes,
amount.
because that one it is assumed that the historical cost is used throughout the year.
Okay.
because that would be the old value, because mostly the old value will be um the historical costs. Okay,
So
the
when we are
historical cost, because mostly
mm,
the depreciation method is on what, the straight line mostly.
mm,
uh, so that's why I said the historical cost. But if you are using old value, it means the depreciable one. Okay. uh
okay. So
uh
when preparing your statements of financial position as at that date, which amounts are you using? Are you using the revalued amount or the carrying amount?
Come again.
I'm asking if we are preparing the statements of financial position as at 31st December, whilst the
Mm-hmm.
revaluation was done on that same date, what
Mm-hmm.
amount are we using for our non-current assets? Is it the
Okay.
revalued amount or the the um the carrying amount after the depreciation?
Okay. So when we started revaluation, I said something. So I said revaluation. How do we measure the assets? I said something about that. Hello, can you hear me?
Yes, I
I
can.
said something about revaluation on Monday. I said that after revaluation, how do we measure the assets? I explained that one. Oh, na some dem me can me kyerɛ no deɛ ayɛ kwa. Hey, macho monkae. I said something.
Yeah, make sure you know. Let me see.
Okay, someone one hello. Someone wants to talk. We are listening.
My network was breaking, so I wanted to know the question you were asking.
Okay, so the one who asked, come again. He said network was off.
Yes, so my question was that the third point where evaluation occurs at the end of the year, that is 31st December 31st December. I'm asking that when you're preparing the statements of financial position as at that date, are we going to use the carrying the amount after the depreciation, or we are going to use a revalued amount when in terms of the non-current assets?
We will use the fair value amount,
The
the
fair value.
revalued amount. Yeah, the revalued amount.
Then we find our revaluation gain or loss.
Yes.
Okay, thank you.
All right. So are you okay? So I said after revaluation, we measure the asset using the revalued amount. Okay. So maybe you are confused because it happened on the last day of the reporting date. Mind you, the 31st December 2018 is also part of what? That year. Hello.
Yes, I'm here. Yes,
Yeah.
please.
So it's part of that particular 2018. So the revaluation gain or losses will also be recorded in that particular year. Okay. Will
All
be
right.
recorded in that
Thank
particular year. So when we get to, I think, reporting after event after reporting date to, I think, IS 10, yes, you appreciate it more. All right.
you. All right, thank you.
Okay. So please, someone should read this one, illustration 14.
Illustration 14.
Okay.
Uh,
Oh, Stella, you can continue.
Oh, Whitney, read.
A company revalued its land and buildings at the start of the year. to 10 million. That is 4 million for the land. The property cost 5 million, 1 million for the land, 10 years prior to revaluation. The total expected useful life of 50 years is unchanged. The company's policy is to make an annual transfer of realized amounts to retained earnings. Show the effects of the above on the financial statements for the year.
Okay. Thank you very much. So this one, we are seeing that the revaluation happened at the start of the year, right? Okay. So let's see. So first of all, let's determine the revaluation loss or gain. Revaluation loss or gain, right? Okay. So we have to land, building. Then we have total. Okay. Now the first one will be the costs. So let me bring. So this one is in millions. Millions. So let me hang 3 zeros. So costs. So the cost is what? 5 million. 1 million for the land. That means 1,000 for land. If 1,000 for land, then 4,000 will be for what? Building. The total will be 5 million. Now depreciation. Now the question you ask yourself is, when was the revaluation? Okay, because we are saying that you have to calculate the carrying amount, or you have to determine the revalue amount, the carrying amount as at what? The revaluation date. So they said that 10 years prior to revaluation. That means after they purchased that particular property, or they acquired that particular property, they did revaluation in 10 years time. Okay, so the carrying amount we are coming to calculate, we have to determine the accumulated depreciation for 10 years. Now let's look at the annual depreciation charge. So annual depreciation charge, we know that we don't depreciate freehold land. It's sometimes leasehold land that we depreciate, but mostly land we saying we don't depreciate, because land will appreciate. But we depreciate, let's say I'll leave that to IFRS 16 leases, so you understand it more. Okay, so the annual depreciation charge will be for building, okay, will be 4,000, because we know the formula already. The cost, there's no residual value, so over the useful life. The useful life as at that date is what? 50 years. 50 years. As I said, we have to determine the accumulated depreciation, but they said that 10 years prior to revaluation. So the accumulated depreciation will be 10 years. So someone should tell me the annual one before we move on to the accumulated one. So please, 4,000 divided by 0 is what?
The annual one is 80.
80. Thank you. Let me write it somewhere. You will come back to it. Okay. So please, give me the accumulated one. So for the 10 years.
800.
So please, I hope you understand why we are doing it times 10.
Yes.
Okay. So the carrying amount assets. Okay, so this one there is no date, so you let me leave it. Let me just write carrying amount. Will be we have 1,000 here. You have 3,200 here. When we add it, you get what? 4,200. Now we know that the revaluation happened somewhere here, or occurred somewhere here. So here will be revaluation. And this one is after the 10 years. Okay, so they are saying that they revalued its land and buildings at the start of the year to 10 million, 4 million for land, 4 million for land. So land will be 4,000. Then definitely building will be the rest. That is 6,000. Total is what? 10,000. Okay. Now let's find the revaluation differences. Let's find the revaluation differences. Now, as at 10 years later or 10 years time, the carrying amount for land was what? The amount in their book was 1,000. You know, we don't depreciate the land, so it is 1,000. 10 years later, it was revalued to 4,000. Definitely, they are making what? Revaluation gain or surplus of 3,000 for the land. For the building, it is 3,200 in their books, but the revaluation is saying that it's 6,000. Okay, 10 years time is 6,000 or 6 million here. So the revaluation gain is what? 3,000, 6,000 minus 3,200 will be what? Hello,
2,800.
2,800. So the totals will be 5,800, right?
Yes.
Now, this is to the up to the revaluation date. Okay, this is up to the revaluation date because this particular example is not having date. That's why sometimes it confuses a bit, but I think we will be fine. I think we will solve one of the past questions like the same example, and that one is with date, so that one you will appreciate it better. Okay, so this one is at the start of the year. So we've determined the carrying amount at the start of that year. Okay, and we compare the revaluation at the start of the year. So the revaluation or the depreciation charge for that year will be determined using the revalued amount. Using the revalued amount. So the depreciation charge will be on this value. Okay, will be from this value. So now we have to determine the figures from revaluation here to the reporting date. So if this one is 1st January a certain year, we have to calculate as at 31st of that year. So that one will also continue. We'll continue from here. So let me bring this one. Okay, so let me just write the revalued amount. I want to start here. Okay. So for land, I have building, then we have total. Okay, so the revalued amount, land was what? 4,000. Building was 6,000, right? Total will be 10,000. So depreciation for that particular year will not be on the for land, we know that we don't depreciate. So for the building, the depreciation will not be on this 4,000 again. That is the cost here. The costs will not be on this 4,000 again. Rather, it will be on the revalued amount, 6,000. So depreciation for that particular year will be 6,000 divided by what? Remaining useful life as at the date of what? Revaluation. So I said that whenever there is revaluation, okay, you use the residual value as at that date or as at that time, and also the useful life as at that time. You will not use the original useful life. No, you use the remaining useful life. Now the term is 50 years. We've consumed 10 years because we are saying that prior to revaluation, 10 years prior to revaluation, before they did revaluation, 10 years, we've consumed 10 years out of the 50. So now it's left with what? 40 years. It's left with what? 40 years. So that particular year, it will be 6,000 divided by 40. This time around, there is no accumulation. There is only 1 year. There is no accumulation. There is only 1 year. So it will be over the 40 years. That's all. So please give me the annual one for the building. Hello,
150.
150. So we will prepare the extract. Okay, so this 150 will go to the P&L for that particular year. This 800 will not come to that particular extract, will not come into that particular extract because this one was the accumulated one, like for the 10 years that we've consumed. But the 150 is the current one. So that one will be in our financial statement for that particular year. Because there is no year, I think that's why it's causing some confusion, but you manage. Okay, so please, this one, you find the carrying amount as at the reporting date. So if there was a date, this one will be the 31st December, that particular year. So we are still having 4,000 for land. Please, what's the carrying amount as a reporting date for building?
5850.
Okay, so what about the total? It will be 9850. Okay. Now, let's determine this extra depreciation or the realized gain. So that one, I said you calculate the annual depreciation on the original amount or the annual depreciation on the historical cost. So the annual depreciation on the historical cost was 80. Then you also determine the annual depreciation on the revalued amount. Okay, here the annual depreciation on the revalued amount is 150 minus the annual depreciation on the original cost is what? 80. So annual depreciation on the, let's say, revalued amount is what? 150. Then annual depreciation on historical costs is what? 80. You find a difference. 70. Sorry, 70, not 700. There's a shortcut. Okay, there's a shortcut. To avoid that particular confusion, there is a shortcut. So when you want to calculate the realized gain, okay, and that realized gain or extra depreciation, I said that at the end of the day, you transfer it from the revaluation surplus to retained earnings. And that one will be a statement of changes in equity. You do that, okay. And when you are preparing the balance sheet, you have to subtract it from the revaluation surplus or the revaluation gain. So the shortcut I'm trying to teach you is what? The revaluation amount, sorry, the gain, okay, over the remaining useful life of that particular asset. That's the realized gain, sorry. Okay, and the revaluation gain for this asset, okay, building, is what? 2,800. One will ask, why are we choosing only the revaluation gain for the building? Because that is the asset that we depreciate. Land, we know land, we did not depreciate, so you cannot take the revaluation gain of land too. So you only take the revaluation gain of that particular asset here, building, 2,800, divided by the remaining useful life. That is what? 40 years. Because initially the building was what? 50 years, and we used 10 years, or we consumed 10 years out of it. So it's left with 40. So divided by 40 years. So please, what is the answer here? Hello.
70.
Okay. So you see, it's the same thing here. Now let's prepare our extract. First of all, let's prepare our income statement extract. Okay. Um, so statement of profit and loss and other comprehensive income. I added other comprehensive income because there is revaluation gain. Because we said that whenever there is revaluation gain under IES 16, they are saying that we record it under what? OCI, not in the P&L itself. Okay. So that one will be depreciation for that particular year. It's just 150. It's a negative figure. Okay. Now you go to your OCI. You record the revaluation gain. Now for the P&L extract, that one you choose the revaluation gain for both land and building, 3,000 plus 2,800. That one will be what? 5,800. Okay. Then let's go to a statement of financial position extract, the balance sheet extract. That one will be PPE, okay, or non-current asset, then PPE. So let me just use NC PPE. Okay, you have land. So land is carried as at what? 4,000. That is a revalued amount. What about building? Revalued amount less the depreciation charge for that particular year. So the carrying amount as at that date was what? 5,850. Okay. Then you go to the equity side. Equity, you will have what? The revaluation surplus or gain. And that one will be the revaluation surplus here, the 5,800. Okay. Minus the realized gain of 70 here, the extra depreciation. So I think this one will be 57.
50 or is it
30.
5,000?
You said?
Please, it's 5,008 5,800. Okay. I've seen it. Sorry.
Yes. Minus the realized gain. Okay. Minus the realized gain. Okay. If you have, then the 70 will be shown as what? Retained earnings. So if you have retained earnings in the question, just have to write retained earnings 70. Now let me do this short workings. The statement of changes in hot equity, the extract. Okay, so this one, let's say we have two components of what? The equity. First of all, we have the revaluation surplus or revaluation gain. We also have retained earnings. This is just an extract. We don't have any opening balance, so the balance brought down will be zero or dash. Okay, we don't have any balance brought down. The revaluation surplus we have in the question is what? 5,800, the two. Then you do that transfer. And what is that transfer? It's the realized gain. Because that one is part of the revaluation surplus. So you have to subtract the 70 or transfer the 70 from revaluation surplus, send it to what? Retain earnings. And send it to retain earnings. So at the end of the day, you are going to get the 5730 as your revaluation surplus. Then retain earnings will be what? 70. So you can choose to show retain earnings here. 70. So that's the end of the question. So please, is anyone having a question? Hello.